Welcome everyone to Vested Interest. This is Shane back again for another Stock Pick of the Day video. It is November 11th. We're going to take a look at one out of the healthcare sector, Abbvie. And if you would like to help out the channel, hit that thumbs up button down below if you find any value in the content. Make sure you subscribe to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Click that notification bell so you're notified whenever we put out any new content. And if you'd like me to buy me a cup of coffee, hit that thanks button down below as well. This is the vested interest stock screener. This is the criteria we will be running through in this video. We will see how it stacks up at the end. It must meet 5 of 8 to make it out of my watch list. If it was a financial company like a bank, we'd go 6 of 9. Now back to Abbvie. Check them out at their homepage, www.abbvie.com. That's www.abbvie.com. That is their homepage where I pulled this information from. And we're just going to go through the numbers. They are a pharmaceutical company. That's what they do, right? And they're over all impact by the numbers, 75 plus conditions treated, right? So they have patents on 75 plus different types of drugs that you can get over the counter medications, prescribed and otherwise, I think. 175 plus countries where products help people and patients, 50 million people treated per year. That's really not as important to us, 50K employees, but they are worldwide. That's what you really want to take out of this, in my opinion. Now, this over here I clipped and superimposed on top of it. This is important. You want to understand a drug manufacturer like Abbvie, like Pfizer, like any of them, Bristol Myers Squibb, any of them that you're looking at. What is their pipeline? Because eventually these drugs are going to reach the end of their patents, and they've got to be either replaced, and other companies are going to come in and they're going to put cheaper versions of that same one on the market. That's where you get generics that come in, right? So you want the pipeline to be strong. So they do have a pretty strong pipeline. They claim 90 compounds, devices, or other phases of development, 7.8 billion in research and development, 50 plus commitment are in progress, mid and late development, and they say 80% are at clinical development with a novel mechanism of action. And that basically means that they're going to try to mix existing drugs to target like cancer cells, for example. They might have something new that's come out there. They've already treating people with cancer, and they've got a new drug that helps with cancer patients. So they plug it in with that same drug, and I think it helps bring it to market quicker, is my understanding. And they've also already got a pre-built-in market for it, right? If you're already taking cancer drugs and there's this new drug on the market that's supposed to help, and you can take it in conjunction with what you're already taking, kind of mix the two together for a new pill, you probably would do that instead of taking 2 pills, right? So they're looking at how to improve existing drugs by mixing other drugs that are already on the market with them, or new drugs that come on the market, mixing those with existing to make them better. And that's kind of what that means, or that's my understanding of it. If it's not, let me know in the comment section down below if someone has a better explanation than that, but that's how I took it. Now, the reason we are taking a look at them, down 12.58% on the day, huge drop on the day. We are talking about Abbvie Inc., ticker ABBV, out of the healthcare sector, closed out the day at $174.41. 52-week range as low as $136.30, as high as $207.32. They are not quite within 52% or 15% of their 52-week low. They need to drop down below 156 per share, 156 and some change really, but in the 156 or lower range would be within 15% of their 52-week low. Market cap of $308.207 billion, a beta of 0.61, so they are less volatile than the overall market. Price to earnings ratio, PE ratio on this one is getting way up there, 60.77. That's extremely high. Earnings per share, EPS sitting at $2.87 per share. Earnings date, January 30th. The next one is going to be in that window, January 30th through February 4th. Forward dividend, $6.56. They are quarterly payers, so divide by 4, though we will see that here in a little bit. Dividend yield is nice at 3.29%. Ex-dividend date, January 15th. Looks like they're going to pay out on February 14th of next year. So you would need to buy them at least February 13th or before. Don't wait till the ex-dividend date, or I'm sorry, January 14th or before. Don't wait till the ex-dividend date. You're not guaranteed to get the dividends. The ex-dividend date, a lot of times if you were to buy on that date, the person who you're buying from actually owns the shares until the end of that day. Then you would own them the next day. So the day before ex-dividend date, you want to buy if you want to get the dividend, 114. 1-year target estimate, at least according to Yahoo Finance, $211.24. So they do see some upside as far as price appreciation from where it currently sits. We're going to check out dividend yield theory to see if this one is potentially undervalued. To do that, we look at their current dividend yield, or I'm sorry, 5-year dividend yield of 4.16%. We compare it to their current 3.29%, or over here it says forward 3.29%. And since it is lower than their 5-year average, that speaks to overvaluation on this one, and quite a bit of overvaluation, at least according to dividend yield theory. Payout ratio is also extremely elevated, 213.59%. Now, a company getting out of whack for maybe a quarter or something for free cash flow, not a big deal. But whenever a company has 2, 3, 4 quarters in a row where they have payout ratios like this, you want to start having some concern, because it means a potential dividend cut, right? So 213.59% payout ratio is not sustainable. That means they're taking on debt. They're using all their cash flow. They're doing something. They're selling additional shares into the market. They're doing something to make this cash up to be able to continue to pay out a dividend with such a high payout ratio. They may not be doing that now. Like I said, they might have enough cash to generate for several quarters into the future, but taking money out of however they're doing it, but not sustainable over long periods of time. Dropping down, we're going to look at free cash flow. I want growing free cash flow over time, because typically if a company has growing free cash flow, they have growing dividends to match. Going back to 2021 here, you can see 21.9 billion in free cash flow. 2022 up to 24.2 billion. 2023 dropped down to 22 billion, and then so far in the trailing 12 months, still have a little bit left to go in 2024 here, but 15.6. So it looks like it's going to be even worse in 2024 than it was in 2023, which was a drop from 2020. So the last several years actually seen some decreasing free cash flow here. They are repurchasing their own shares, 934 million here, 1.4 billion in 2022. They were up a little bit in 2023, but it does not account for the drop in free cash flow. So I'm definitely seeing a drop in free cash flow in 2023 compared to 2022. And it looks like same thing here, down with their repurchase of shares as well as free cash flow down. So definitely looks like they may be down here, unless they have 2 banger months here in November and December. Looks like they're going to be down here over the trailing 12 months also, or over the 2024. Now, jumping over to stockanalysis.com, the previous information was brought to you by Yahoo Finance. I'm not affiliated with either site, just 2 sites I go to for information, and I do recommend more than one source. Don't just blindly trust one source. You want to make sure you're comparing 2, if not 3, so you can make sure the information you are getting is accurate and up to date. You pick any sources that you want, just I would go with more than one. Now, they do have 18 analysts that have taken a look at this. They call it a strong buy, a low estimate of $150, which would represent a 13.99% further decrease from where it currently sits. Average estimate of $204.94, a little bit lower than what we saw with Yahoo Finance on the previous page, but pretty close. That would represent a 17.5% increase from where it currently sits. And if it happened to hit their high of $231, that would represent a 32.45% in price appreciation, and you could get that 3+% dividend yield, as long as they don't cut it, like I said, with a 200% payout ratio. That's extremely high. Return on equity and return on invested capital are also 2 metrics I look at. I like 10% or better. Return on equity, very high, 56.41%. Return on invested capital, over the 10% I like, sitting at 14.32%. Very good numbers and very high return on equity. That's very nice, actually. Return on invested capital, decent too. EPS growth forecasted, I like 5% over the next 5 years, 43.08%. Now, I don't know if that justifies the 60% PE, because they do even have revenue growth forecast at 5.75%. So that doesn't seem to be in line with the price earnings of 60 either. I mean, I would expect much faster revenue growth for something with a 60 PE. Earnings per share over 5% though at 43.08%. Now looking at their history here, they are a quarterly payer, 228.58% dividend yield, 5.01% raise over the last year. Sorry, I clipped off that top part, but that's what that means, 5.01%. So they are raising the dividend over time. I'm questioning whether they should be with a 228% payout ratio. 52 years of growth, though, so they are steady Eddie. Buyback yield of 0.07% is positive. Shareholder yield at 3.81% is positive as well. So when they are buying back shares, they're doing it pretty efficiently. Now, they do pay out on the February, May, August, November, so they're off the typical months payouts. Typically, they start in March, June, September, December time frame for those. But anyways, going back to 2022 here, they were paying $1.41. January 2023, they raised it up to $1.48. Raised it up again January 2024 to $1.55, and it looks like they're going to continue that streak there in January 2025. They've already said they're going to raise it to $1.64 from $1.55. So they're maintaining that 5% dividend increase there. You can already see they're accounting for it for that February 14th payout. All right, well, where do they stack up in the screener? As you can see, understand the business. That's why we started their webpage right there, a pharmaceutical company. That's what they do. So check there. Growing free cash flow over the last 4 years. Nope, they had a couple down years, so no check. Actually, been dropping the last couple of years. Growing dividend, yes. Dividend payout ratio is over 75% right now, over 200%. Very, very elevated currently. Dividend yield theory says they're potentially overvalued, so no check there. They are not within 15% of a 52-week low, so no check there. Return on invested capital and return on equity both over 10%, so check there. And earnings per share growth is over 5%, so check there. We're looking at 4 out of 8. Doesn't quite make it onto my watch list. Let me know what you think of Abbvie in the comment section down below. A lot of you may have it in your portfolio. Is it one you are adding to on the pullback? Would love to hear from you. Well, that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments, so drop a comment down below. Let me know what you think of Abbvie. Let me know what you think of the channel, and we will talk to you on the next one. This is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.